Welcome to the Deep Dive. We're here to sift through the complex research and give you the core knowledge you need. Today, we're doing a deep dive into Coforge Ltd, specifically their Q2 financial results for fiscal year 26. That's the quarter that ended September 30th, 2025. They're a big global IT services player, and the sources you provided, they're quite rich, aren't they? It's not just the standard profit and loss stuff.
No, exactly. We've got the core financials, sure, but also a lot on their business momentum, how they're diversifying operations, even some really interesting bits about their internal culture and dynamics. So our goal today for you listening is really to get under the hood. Why the impressive growth? What fueled that big margin expansion? And crucially, what do those forward-looking metrics, like their order book, suggest about where Coforge is headed in the near term?
Okay, got it. And the sort of key takeaway right at the top, Coforge had a robust Q2. Revenue jumped 8.1% quarter-on-quarter in rupee terms.
Which is strong.
And maybe more importantly, a really noticeable expansion in their EBIT margin.
That's the one that caught my eye, too. Okay, let's get into it.
All right, first section, financial performance. Let's start with that top-line growth. It felt like quite a surge. Gross revenue came in at INR 39,857 million. That translates to about $462.1 million for the quarter.
Yep.
And like we said, that sequential growth, quarter over quarter, was 8.1% in rupees. Year over year, even bigger, 31.7%.
And it's important to look at constant currency too, right, to strip out those FX fluctuations.
Good point.
In constant currency, the growth was still really solid, 5.9% quarter over quarter and 25.7% year over year. To me, that shows real underlying demand. It's not just currency helping them out. Businesses clearly want their digital services, things like AI, cloud, data. The core engine is firing.
Okay. So strong, stable demand fueling the top line. Now let's talk profitability, because that margin story is pretty dramatic. EBIT margin hit 14.0%.
Yeah, 14.0. And the increase is what's striking. That's a jump of 251 basis points, or 2.51 percentage points, just from the previous quarter. Wow. And 240 basis points compared to the same quarter last year. You don't usually see margins jump that much, that fast in this industry.
So that suggests something structural changed, right? Not just a good quarter.
I think so. It implies deliberate actions on efficiency, which we can probably dig into later.
Okay, and this strong operating profit flowed right down to the net profit, the PAT.
Absolutely. Profit after tax was INR 3,758 million. Now listen to this. That's up 86% year over year.
86%. That's massive.
And 18.4% quarter over quarter. So yeah, really efficient conversion of that revenue growth into actual profit.
And they shared some of that success directly with shareholders too. Announced an interim dividend.
Yep, INR 4 per share. Record date set for October 31st, 2025. So putting their money where their mouth is, essentially.
Okay, so Q2 was clearly strong, financially speaking. But, the market always looks ahead. What about the future? How confident are they feeling? The CEO, Sudhir Singh, is quoted sounding pretty optimistic. He expects an exceptional fiscal 26. Yeah. Talks about this being their 9th consecutive year of sustained and robust growth. Strong words.
Well, the proof is often in the order book, isn't it? That gives you the real visibility. Yeah. And the order intake this quarter, the total contract value, or TCV signed, was $514 million, which is, a solid number.
Okay, $514 million in new contracts signed.
But the really important number for future visibility is the order executable over the next 12 months. Think of that as revenue they've already got locked in, ready to be delivered.
Right, the confirmed pipeline. And how does that look?
It looks very healthy. It stands at $1.63 billion.
$1.63 billion.
Yeah. And that figure itself is up 26.7% compared to where it was a year ago. Yeah. It provides a huge buffer, a lot of confidence for the next year, regardless of, wider economic jitters.
Makes sense. And they seem to be landing bigger deals to build up that backlog. The report mentions 5 large deals signed this quarter.
That's right, across North America and APAC. And it builds on momentum. The CEO noted they closed 10 large deals just in the first half of this fiscal year.
Which follows what? 14 large deals last year. So they're consistently winning substantial contracts.
Exactly. It shows they can scale relationships and handle complex, large-scale projects. But what's also interesting is how they're managing client concentration while doing this.
How so? Because the repeat business number is still very high, 95%. That suggests strong loyalty.
It does, which is great. But they're also bringing in new blood. They added 9 new logos, new clients this quarter. And look at the breakdown of large clients. They're $10 million plus clients. That group grew from 29 clients a year ago to 34 now.
Okay, so more big fish.
More big fish, yes. But crucially, the revenue share from their top 10 clients actually dipped slightly quarter on quarter, down to 30.8%.
Oh, okay. So they're growing the number of large clients faster than the reliance on the very top ones.
Precisely. They're landing whales, but also spreading the risk. That's smart diversification within their growth strategy. Textbook de-risking, really. Hashtag 3 City. Strategic shifts in business mix.
Okay, let's pivot a bit. Where is this growth actually coming from within the company? Let's talk about the business mix. The vertical breakdown is fascinating. We have to talk about travel, transportation, and hospitality, TTH.
Oh yeah, that one jumps off the page.
A 60.8% year-over-year growth rate. 60.8%. That's extraordinary. TTH now makes up 23.3% of their total revenue.
That TTH number, 60.8%, that might be the most revealing piece of data here. Think about what that implies.
Okay.
It's not just people traveling more post-pandemic. That scale of growth suggests the entire sector is undergoing a massive digital overhaul. They're investing heavily in new systems.
Like what kind of systems?
Think next-gen booking platforms, AI-driven loyalty programs, optimizing routes and inventory. Really complex stuff. And Coforge seems perfectly positioned to capture that wave of modernization spending. That's why it's growing so much faster than other areas.
Interesting perspective. So it's a sign of deep transformation in that industry, not just recovery.
I believe so. Meanwhile, their traditional stronghold, banking and financial services, BFS, remains the largest chunk, right?
Yeah, BFS is still number one at 27.6% of revenue.
Stable core.
And geographically, where's the action?
The Americas still dominate. 57.9% of total revenue comes from there, and it grew 6.5% quarter on quarter.
Right, the main engine.
But the fastest growing region year over year was actually rest of world, up 48.7%.
Okay, so they're getting significant traction outside the U.S. too. That supports the diversification story.
And looking at what they actually do, the service offerings, engineering services are the big one now.
Yeah. How big?
46.1% of revenue.
Yeah.
And that segment grew almost 40% year over year, 39.9%.
Wow. That aligns perfectly with the TTH story, doesn't it?
How do you mean?
Well, when these travel companies or banks modernize, they don't just buy off-the-shelf software. They need heavy-duty engineering to build, integrate, customize. Ah, okay. So the demand for engineering services reflects that deeper modernization spend. Clients are building new things, not just maintaining old ones.
Exactly. It's high-value, complex work.
Now, earlier, we talked about that big jump in the EBIT margin, the 251 basis points. And you suggested it was structural. Did the sources point to any specific efficiency moves?
They did. There was a specific action mentioned regarding UK subsidiaries.
Right. They approved the winding up, or striking off, of 2 UK entities, Coforge SF Ltd and Coforge DPA UK Ltd.
And the stated reason was key, to bring synergy in operations and enhance cost efficiency.
So, simplifying the structure, removing duplicated costs in the UK.
Precisely. It's a clear operational efficiency play. You combine that kind of cost discipline with the strong revenue growth we discussed.
And boom, you get that significant margin expansion. It connects the dots.
Exactly. The efficiency move here directly enabled the profitability boost we saw earlier. It wasn't just luck. Hashtag high V, human capital, and corporate culture.
Okay, so they're streamlining structures, growing fast, making good profit. But IT services, at the end of the day, it's a people business, right?
Absolutely critical.
So what did the sources say about their human capital side? Especially given that push for cost efficiency we just discussed. Did they cut headcount?
That's what's really interesting. No, quite the opposite. Their total headcount actually went up, reached 34,896 people.
Up how much?
They had a net addition of 709 employees just in this quarter, sequentially.
Wow. So they added over 700 people.
Yes. And the report specifically highlights this is happening at a time when the industry in general has been witnessing layoffs.
That's a major counter-trend move. It speaks volumes about their confidence, doesn't it?
It really does. They're staffing up because they need the capacity to deliver on that $1.63 billion order book we talked about. They're hiring for the growth they've already secured.
That makes sense. They're preparing for execution. And are they keeping the people they have? What about attrition?
Another bright spot. Their LTM attrition rate, that's last 12 months, was down to 11.4%.
11.4%. That's very low for this industry, isn't it?
Extremely low. The source describes it as among the lowest in the IT services industry. Low attrition is a huge advantage, saves on hiring, training, keeps knowledge in-house, ensures delivery consistency for clients. It removes a major headache.
So what's keeping people there? Is it just the growth prospects?
Growth helps, but the sources also point to culture. Coforge was certified as a great place to work again for the 5th year running,
Okay, 5 years. That's consistent.
and recognized as a most preferred workplaces 2025-26 for the 4th time. You don't achieve attrition rates like 11.4% without a strong, positive culture underpinning it.
Good point. Culture often translates directly to retention, and they seem focused on external recognition and responsibility, too.
Yeah, they picked up the Golden Peacock Award for Excellence in Corporate Governance for 2025. That speaks to strong oversight and ethical practices.
And there was a nice CSR mention, too. Corporate social responsibility. Yes. They opened their third Coforge public library, this one in Hyderabad, and that project itself got recognized at the India CSR Awards as one of the top projects of the year.
So it looks like they're trying to perform well across the board, financially, operationally, culturally, and ethically. Hashtag outro. All right, so let's wrap up this deep dive on Coforge's Q2 FY26. The picture seems pretty clear. Strong, structurally supported growth and profitability. Key takeaways for me: the impressive 8.1% QOQ revenue growth in rupees, the massive 251 basis point jump in EBIT margin quarter over quarter.
Driven by real efficiency moves.
Right. And that future stability, signaled by the $1.63 billion executable order book, looks quite solid.
I agree. The final analysis really suggests this wasn't just a lucky quarter. It was the result of, really good sales execution, landing those 5 large deals, combined with smart operational tweaks like streamlining the UK entities. And all of that is built on a stable, growing workforce with remarkably low attrition. They seem to be firing on all cylinders, executing their strategy effectively, high growth, improving margins. Okay, so it all hangs together. But it does leave us with a question to think about, doesn't it? Something for you, the listener, to mull over. Given Coforge's success in high-growth areas like that incredible 60.8% YoY growth in TT, and their focus on advanced techs like AI, there's a potential tension.
Which is?
Well, how sustainable are these really high above-average growth rates when the bulk of their revenue, nearly 58%, still comes from just one region, the Americas?
The geographic concentration point.
Exactly. To keep this momentum going long-term, what kind of pressure does that concentration put on them to significantly expand their market share in places like EMEA and the rest of the world? Can they truly diversify globally while maintaining this growth trajectory?
That's the strategic challenge, isn't it? Balancing focus with global reach. Definitely something to watch. Okay, great discussion. Thanks for joining us for the deep dive.